Okay, today we're going to be looking at a very powerful ICT concept called the power of three. So we'll look at what is the power of three, how do we identify this power of three, and then how do we trade using this power of three. It's a very powerful ICT concept. So basically, that's what we're going to be learning about. And we're also going to also make use of the knowledge that we're learning about order blocks, all those institutional reference points that we learned about, and we are going to apply it in this concept. That's why it was one of the last courses that we are going to be looking at. So basically, we're going to be looking at a bullish scenario. Then the bearish scenario would definitely be the opposite of this bullish scenario. So it's basically the same thing. So when we talk about the power of three, we have what we call accumulation, manipulation, not manipulation, manipulation, accumulation, manipulation, and distribution. That's the concept that we're gonna be looking at. So you'd see that we are basically looking at how price is delivered, price delivery that normally takes on a daily basis, or it can also take place on the monthly or the weekly. But in our analysis today, we'll be focusing on how the accumulation, manipulation, and distribution concept is applied on a daily basis or time frame. So what you would see is this: during the Asian session, where price tend to accumulate or tend to range. This is the session that we are looking at, where price is accumulating orders. So basically, during the accumulation process, what will be taking place is this smart money concept. So in trade, basically, when you're buying, someone has to be what? He has to be selling. So during this phase, the smart money traders, or the smart money traders are accumulating their orders. So here they are buying. That's why there's this consolidation. And like if you try to go back to our previous discussion where we talked about rate on liquidity, and we said that when this range is taking place, in most cases, below this accumulation or this consolidation, there will be buy side residing below this level. So we have buy side liquidity residing below this level during the accumulation, and we also have sell side is residing below this level, and we have buy side above this level. So like what I said, in most cases, price is normally moving to do two things. Price will normally move to do two things, which is to grab liquidity and also to fill up an imbalance. So during the accumulation period, buyers will place their stop losses below this level. Below this level, we have buyers placing their stop losses below this level. And we discussed thoroughly how those stop losses can be, when we talked about rate on liquidity, that's a form of what? Sell side liquidity. So we have also people who are waiting. We talked about retail traders. They will be waiting for price to break out from the what? From the range. So they will also place their sell stops below this level, targeting that when price breaks out from this consolidation, they are going to be sell. So we have two forms of what? Buy sell side liquidity, which in the form of stop loss and sell stops below this level. So what these smart money traders will do is this: once they are done accumulating the orders during this process, they've managed to buy from these people who are at this particular level. So what they then do is this: they then manipulate the price to come down. Why? There is liquidity residing below this level. So the manipulation is being done so that they can trigger the stop loss and also raid sell side liquidity residing below this consolidation. So basically, that is what is taking place here. So after the accumulation, we have manipulation that is being done by smart money traders to get liquidity that was residing below this level, sell side liquidity to be precise. after that has been taking place, so basically what they're aiming to do, these guys, like what we discussed in our previous lessons, these guys are always looking to buy at a very low price. So when they manipulate the price to come down, they can now buy at a very low price. So they want to buy when the price is low, and they want to distribute it and sell it when the price is high. So when we are just using common business sense, you would want to buy, if you're buying and buy when the price is low, and you want to sell when the price is high. So basically these guys, this is what they are doing. They are buying when the price, they are manipulating the price so that they can buy at a very low price, and then they can now sell it at a very high price. So you would see that, so after the manipulation process, they've taken out sell side liquidity. There's a red on liquidity here, or there's a grab or a liquidity swept below this level. They then manipulate the price, they then distribute here. During the distribution process, that's where you see the price then moving upwards, and at this particular level they start selling here. There will be also some retro traders who would also want to continue buying at this particular level, and these guys, they know this, they start selling at this particular level, and the day will end. So this is normal, this is always taking place. It will not always take place, but in most cases this is always taking place. This sometimes take place on a daily time frame. So let me try to show you how the daily candle looks like, and how this type of manipulation will be taking place. So we have the daily candle here. So in most cases, when we are looking at a bullish candle, the bullish candle will be like this. So we have, last time we talked about the four important parts of a candle. We said we have the candle open. So this is what a bullish candle, implying that price was moving upwards. Price was moving upwards. So this is a bullish candle. So that means price opened at this level, and there was a period where price dropped a little bit here. So when the day started, there were some sellers who took over, and they were able to push the price downwards, and then the price then moved upwards, and there was a period when the price reached this high, and then eventually closed at this particular level. So we have the four important parts. We have the candle open, the candle low, the candle high, and the candle close. So this is a bullish what candle. This is a bullish candle. Okay, so when we drop down, so this is how we can see a daily candle. This is how we can see a daily candle. A daily candle, when it's bullish, will look like this. So when we drop down to a 15-minute time frame, when we drop down to a 15-minute time frame, we are going to see something like this. So on the 15-minute time frame, this candle, this daily candle, will appear like this. We have here the open of the candle, where the consolidation or the accumulation is taking place. It is taking place during this level. So price will be relatively flat. Price will be fluctuating during this period. And then we have the manipulation. So this lower week here, when the price was able to establish a low, is what we call the manipulation. This is the manipulation, and then the distribution is now taken after the manipulation, and then we have the distribution here up until price reaches this level. So when you go to the 15-minute time frame, you'll be able to see similarly this structure. And now that we know that this is what is taking place, let's quickly try to identify some examples. Then the last part, we then have to look at how we can trade using this. So what I'm gonna do is this. I'm gonna go to the 15-minute time frame and identify how the manipulation, the accumulation, manipulation, and distribution would look like. So let's try to identify how this concept would actually look like, and then we then look at how we can trade using this concept. So this concept can be used. We can use this same concept to trade. So we're gonna focus on this particular period. Okay, so we have this here. on this particular day, what was this, 23rd of December, so no, yeah, 20, it was on the 20th of December 2023. Okay, so we have here a period where the price was this is the what, let's identify the three powers or the three phases. We have one, the accumulation. So the accumulation is taking place at this particular level. During this level, that's where the smart money traders are accumulating their orders. They are accumulating their orders at this particular level here. And then during this phase, let me just highlight it here. That's when we have the what? The manipulation here. So the manipulation is here. This is where the manipulation is taking place. Just wanna, okay, so that we can see nicely. So the manipulation took place at this particular level, where some traders thought that the retail traders thought that the price is now going to continue coming down, and they were able to sell at this level. And here, obviously, when the price was moved upwards, they found themselves in a loss. And also, some people who were buying at this particular level when the consolidation was taking place, their stop losses were here. And when the price was manipulated to come downwards, then obviously the stop loss were hit. So here we can talk about the raid on liquidity. Price was able to grab liquidity that was residing below this level. So here, when this manipulation is done, we have the price now making the distribution. So this is a good example of how this power of three concept, ICT concept, can be identified on a chart. So let's look for another example. And here again, we now have a situation where we now have, this is the accumulation, where we have the consolidation at the start of the day. So I've put period separators so that you can see that this is actually taking place. So we have one, the Asian, during this Asian period. We'll talk about Q zones. I think if time permits, we'll talk about the Q zones. And then now what do we see? We have price being manipulated to move upwards. So we can see the three phases here. We now have manipulation at this particular level. We have manipulation here. So now we're just trying to identify how we can see is this concept applicable, how we can apply this concept of the power of three. And then we have the distribution phase, which is here. We're now looking at a bearish scenario. So here, this was the distribution phase. Let me just choose a different color. Okay. So we have the distribution. So this, in most cases, this is normally taking place on our chart. This will be taking place on our chart. And if you're able to identify these three phases, you can now come up with a good and powerful trading strategy to trade this concept. You can see, so this is a bearish scenario with the accumulation, the manipulation, and the distribution. So this, in most cases, is normally taking place on a daily basis, and we have a bullish scenario where the price, we have the accumulation, the manipulation, and the distribution. So we also have the different phases here at this particular level. So we can see on these two examples that this concept is a very applicable concept. So it applies in all financial markets. Even if you go to a booming crash, your synthetic indices, your gold, your currencies, this is taking place in all these markets. Okay, so here we have our distribution. So here we're just trying to identify the different phases that we have. So here we have our accumulation, manipulation, and distribution. So now that we've managed to identify that this thing, yes, it's actually taking place in these markets. So the biggest question is, how then do we trade using this concept? So there are two ways that we can trade using this concept. There are two ways that we can use to trade using this concept. So what you would want to see is this. After the, okay, we have the accumulation here, and then we have the manipulation. So how then? There are two ways that you can trade this. Some people suggest that you can wait for price to return back to the accumulation, which is this zone, and then once that that takes place, you know that price. This was basically what a manipulation. After the manipulation, wait for price to come back to the what, to the consolidation, which is our accumulation. Then you then wait for price to, sorry, you then have to wait. So here we are accumulating orders, and here, so this is what is taking place. Then you then have to wait for price to return to a institutional reference point. So here obviously there's going to be a change of character, and here you wait for price to drop down to a institutional reference point, and then from there, that's where you take your position, and then you join this distribution phase. So when we talk about institutional reference point, it can come in the form of a fair value gap. So in most cases now we obviously will be in a discount. So like what we're going to be discussing, I think at the end of this lesson, we also talk about the PD array. The PD array, I think we've covered most of the concepts that are there, and then how we can use it to trade. So we will be in a what? In a discount. So you want to wait for price. So in a discount, we normally give priority to a fair value gap. So price, we normally give priority to a breaker block, a mitigation block, or a fair value gap before price reaches the what? In order block. So here, if there is a fair value gap on the 15-minute time frame here, that's where you're going to take your position here. So one, so here it can be an order block, or it can be a fair value gap. So here we have a fair value gap or an order block. That's the institutional reference point that I'm talking about. So here we're obviously going to have a what? A change of character. So basically, you don't want to buy when price is still in a what? In a downtrend. So what are you going to do here? You're gonna wait for this. You wait for, sorry, okay, this one. Let me just use color white. You're gonna wait for a change of character. A change of character at this particular level here, which is now signifying that price is moved from a downtrend and is now in an uptrend. Then after price has given you a change of character, you're gonna wait for price to return to an order block or a fair value gap. But if there is a fair value gap in an order block, you must give priority to a fair value gap. If there is a mitigation block or a breaker block, give priority to those ones, because we'll be in a discount, and we want to, in a discount, we give priority to those before we look at a breaker block. There are times when you'll be waiting for price to come to an order block, but price doesn't return to an order block. It will be probably because there's a mitigation or a breaker block, or there will be a what? A fair value gap. So when price return to an institutional reference point, at this point, that's when you buy, and then you move up with the market. So similarly, it will be the same thing in a what? In a bearish scenario. So let's quickly go back to that example that we're looking at, and see if we're going to get an entry after that took place. Okay, here we also have an example. Okay, let's just go back. So we want to look at the examples that we have highlighted. Okay, let's look at this one. Let's look at this part. How are we going to trade? So now we're now talking about how do we trade using the power of 3. That's what we're now talking about. How then do we trade using the power of 3? So we have here the consolidation. And once you have noticed this, you just wait, which is one thing that most traders are not good at, waiting for the price to play out in that way. Okay, then from there, price has been manipulated to come to this lower price because these smart money traders, they want to let me just put my laptop on the charger. Okay. Okay, let's continue. We have here the accumulation and the manipulation. So you are not doing anything, you're just observing that this is what is taking place. Then you then have to wait. You're waiting for what? For a change of character. So sometimes there will be need for you to go even to lower time frames. You can go to lower time frames so that you can get an entry. So one, like what I said, the other method is for you to wait for price to come back to the consolidation. Once this has taken place, you know that this was a what? A manipulation phrase. This was just a manipulation. And then you wait. You're waiting for a change of character. You're basically waiting for a change of character. And let's see. Okay, here we have a change of character. We have price closing below this level. If you move down to the 5-minute time frame, I think you can see what I'm talking about. So you can check this on the 15 minutes time frame and also the 5-minute time frame. You can also check this on the 5-minute time frame. Here, can you see that we have a change of character? Here we have a change of character. This phase, this level, resulted in a break of structure at this level. So that's the most important thing. And I'm always talking about this because most people, they get confused when we talk about a change of character and a break of structure. So a change of character or a shift in market structure should take place after there has been a break of structure. So here we have a break of structure as price was able to break this structure and come downwards. And then when price closes above that level, like what took place here, we have a candle at this level. We have a candle closing above this level here. We have a candle here. So now we have a change of character and we are now waiting. So this is a change of character or a shift in market structure. Let me use green. And here we have the break of structure here. So a change of character will only take place if there is a what? A break of structure. Here we have the break of structure here. So this was a break of structure which took place at this level. So this one is a BOS. We have a BOS here. So this is what I'm trying to say. This level, this high resulted in a break of structure. Once we have a candle closing above that high, that's when we have a shift in market structure, indicating that that downward momentum is now over. We're now moving into a what? A bullish phase or an uptrend. We're moving from a downtrend. So this took place here. And then you wait for price to return to an institutional reference point. Let's see what then took place. We see we have price dropping and price came back to this order block. We had an order block here. Let's see if this order block was the one that was used. And we also have a small fair value gap here, but we have an order block here. Okay, this order block at this particular phase, okay, we're on the 5 minutes. We also have an order block here, but I don't want to talk about this order block. Why? Because I can see that there was also um a candle. The candle here closed below the order block here. Okay, let's see what then happened. Okay, here we didn't get an entry here, but we were able to get an entry at this particular level. Why? Because we have this order block here. We have an order block here. So you're going to get an entry at this particular level here. Let's see if price was going to continue moving upwards. So we now use that order block to move upwards. And then that order block is being respected. And we can see how price started to move upwards. And you're now in the trend. And then we can see how then price started to move upwards. So basically, so this is what I was trying to say. One, we had a change of character waiting for we then have to wait for price to return to an institutional reference point, which can be an order block or a fair value gap or a breaker block or a mitigation block. And here in this case, price returned back to what? To an order block. We had an order block here, the last bearish candle before the price moved up, and then price had to return to that particular order block here, and then we're going to buy when price return here, and then from there price started to what? To move upwards. And then we can see how then price started to move. So this thing, in most, if do your research. Once you get information, you must do your research. Do your research. You see that in most cases, this is normally taking place in these markets. This is normally taking place in any financial, be it cryptocurrency, be it gold, be it synthetic indices. I think there was a day when I was giving signals, giving the using the word the power of three when we're trading volatility, especially in volatility indices. This is very, very common. So this is how you trade using the power of three. Okay, so let's look for another example. We had another example here. Let's see how we're going to trade using that. So we have our okay. Let me just, so we have the distribution taking place here, and we have our accumulation taking place at this particular level. So the accumulation took place here, and then okay, this side is good when it comes to replay, but when it comes to drawing, it's very, very difficult to use the items, unlike TradeView. But TradeView, you have to pay for you to get this replay mode. You see, price was manipulated to move upwards so that they can raid liquidity that was residing above this, which is buy side liquidity in the form of stop loss and also buy stops from retail traders. And then from there, once they were now able to sell at a very high price, here this is the manipulation. And then let's look for an entry, how we're going to enter this trade. Like what I said, we wait for price to return again to the consolidation. Let's see if that took place. Price returned to the consolidation. This is what is taking place. Price is there and you're just waiting. You're just waiting for price to give you an entry. And now we don't have an entry. We don't have anything. So price has to return to an institutional reference point. Let's say, and what do we have here? I don't see an entry here. But here what do we see? We have one, a change of character. We have a change of character at this level. And I will repeat the same thing until you can understand this. So here we have a change of character. And why is this a change of character? It was able to break below this. A candle was able to break below this level, and then this level, this level resulted in a break of structures. Price was moving upwards. So that one is the correct change of character or a shift in market structure. So here we're the BOS. So you can't have a change of character if there is no break of structure. So from there, what do we see? Okay, we are waiting for a position, and here we're the fair value gap. I can see a fair value gap here. You have 1, 2, we have a fair value gap here. Let's see if that fair value gap was used for us to get an entry here. We have 1, 2, 3. We have that candle. Okay, this I now know that you guys know what is a fair value gap. So we have a fair value gap here. Let's see if price was going to use that one for entry, and that fair value gap was our entry signal. So we're going to enter using this fair value gap, and then from there you can see our price. So it becomes very easy to trade when you know this concept. Price was now moving downwards from that consolidation. So this is how easy it is to trade using the power of 3 concept. Let me try to make it fast. Okay, it's fine, but we're going to get an entry at this particular level, and here we're going to be in profit. We're going to be able to get something from this particular trade. Okay, so this is all that I had for you guys, and let me just stop this recording.